So I'm Valérie. I'm very happy to be here and to share with you some insight about the venture capital market and the way you have to introduce yourself towards venture capitalists just like me. Maybe I will start with the different type of funding that are adapted to different stages of development of your company. I'm going to cover that very fast because I think most of you know about that. And maybe I'm going to start with a point that you made earlier, Karen, about shall you raise capital or shall you raise debt? So that I just get help of these questions. You can raise easy debt from the government in your different country, especially in countries like France or even Germany, where you can get funding for a small amount from few hundred euro to 1 or 2 million to finance R&D and innovation. That's something you have to grab because it's non-dilutive money, and that's fine. At the different stages, it can complete an equity round. But for all the other situations, as soon as you're burning cash, there's no other way than raising capital. If you're trying to go into exotic stuff like venture debt in too early stages, this could put your company really in trouble and in danger. Because remember that debt is to reimburse, and usually those venture debts are a very high price, something like 12 to 15% total interest altogether that usually are capitalized. So make the math and you'll see that when you're borrowing a few million euro, even at stage where you think that your company is nicely growing and so on, it can be very dangerous for your company. I just had bad experience with venture debt, and especially because it's difficult to put in place, and there's a lot of disadvantage that that those people are asking from you. They're asking to have some warranty on your assets, for example, or on your software code. They're also asking for warrants. So you'd think it's not dilutive, but it can be highly dilutive if you're not capable of reimbursing. So venture debt can be useful if really you're next to break even. You're looking for the 1 or 2 or 3 million that you need to reach this break even, and that's it. If you're still burning money in a large manner, that's not the way you're going to finance yourself. So that's just to put the point that Karen put on the table about debt versus equity. So here I'm going to talk only about equity. And those are the different stage of a company from seed to expansion. And you're probably familiar with that. When you started, it was just an idea, and you want to build your MVP. This is probable that the money you will get is from friends and families, from your grandmother and from your aunt, because there's the people who will believe in you at the very beginning. And that's not an issue. And of course, you can bootstrap your MVP and get your first, let's say, customers or POC, and this is going to be the time to look for seed money. Seed money round can be quite large right now in Europe, starting from a few thousand euro to even 5 million euros, even bigger round when entrepreneurs are what they call serial entrepreneurs and had success before in another venture. But let's say that for the normal entrepreneurs who is funding his first company, this would be probably around 500K to 2 to 3 million euro, basically. And this money you can get from angel investors. You can get them also from startup studios. There's a lot of entrepreneurs in Germany, in France, in the UK that have been successful in the past and that have built those entrepreneur studio where they bring resources to entrepreneurs who have an idea but not the technical resources or marketing resources, for example, and they put the first few euros at work to build the MVP. Then after a few years, you're going to reach the magic number of 1 million in booking, in ARR, around 1 million. It can be from 500 to 1 million in ARR. For a SaaS business where you are eligible to Series A financing, and when you are eligible for Series A financing, you can get the money from classical VCs just like us. Those Series A can be quite big. Typical Series A in Europe would be 5 million with 2 investors. And again, we'll come back on how to pick up your investors. Try to find smart money and people that get together when you mix investors. Because if they can't get together, it's going to be a nightmare for you during your board meetings. And what the difference with the Series B? Series A, you're around this 1 million in ARR magic figures. For Series B, you're around 3 to 5 million in ARR. And you need to fund your business for international expansion usually. And then there's plenty of routes, but for the most promising business, you can try the US game, because this is where your company will grow the faster. I make a point there. This is not always the best way to build up a company. Not all SaaS businesses are suited for that, and not all management teams are suited to that. I'm sorry to have to tell you that, but this is completely true. If you don't have the right team, the right people that think internationally from the very beginning of the startups, you won't be able to make it in the US. That's really my point. And then you have all this expansion capital that can be really huge. We've seen C rounds, D rounds, E rounds that can be up to 100, 200 million euros. Usually in the B2C kind of scale-ups, but it can be also in the B2B space. It's not coming that the B2B SaaS startups can attract such amount of capital. And again, that's not all teams, and that's for very, very special games. When you raise a 100 million round, it's going to be probably at a valuation above 500 million, meaning that the investors is waiting for an exit valuation of 1.5 to 2 billion. So you need to be aware of that, and you need to be strong enough to support pressure to be able to deliver on that plan. And that's really the point. As soon as you raise money, you have to figure yourself what's going to be the business plan. I am able to deliver this business plan or not, and don't hang you up, because then it can be a disaster in terms of equity story. Exit for VCs are usually M&A, mostly M&A. 90% of our exits are M&A. They can be some IPOs for the very few of the companies that are reaches more than 100 million in ARR. Usually on NASDAQ. There's no real market for tech here in Europe, so it's tough, and it's highly costly. Imagine that the cost of an IPO will be 10% of the proceeds you want to get from the IPOs, so around 10 million euros if you're raising 100 million euros, and will cost you probably 2 to 3% of your P&L just to maintain you on NASDAQ and on those stock markets. It's a lot of efforts. So usually it's not the right route for us to exit. Usually the right route is more M&A. If you have any question, feel free to interrupt, of course. Then just some numbers about the VC trends and the VC market, and that's very good news for you guys, because there is plenty of cash into that market. As you can see, it's quite tiny, but as you can see, over the last 18 months, VC investment in Europe have reached 50 billion euros. And as you can see, from 2016 to 2019, the market doubled, basically, in terms of amount that had been put at work in startups. And what you can see on the left-hand side, it's really tiny, I'm sorry, that, again, the size of the capital that the startup are able to grab are getting higher and higher. The gray bar that you have here is the capital round above 25 million euro in Europe. So as you can see in 2019, it's huge. It's almost 60% of the money that has been raised from the 4,000 startups that have been able to raise capital. And this is just to go deeper into those numbers. What you can see also is a growth in every stage of the investment category, from seed, very nice growth over the last 4 years, from 3.7 billion euros to 4.4. Nice growth of the VC startup stage, nice growth of the growth stage. So it's not only, we have always in mind that this is those very large VC growth funds that fuel the market. That's not really true. There's money for everyone at every stage, and it's scaling very well and very nicely.
Valérie, where's all the, you said there was 2x in the amount of money available. Where's it all come from?
Where does the money come from? There has been some trends in the market. For example, the corporate ventures put a lot of money at work. That's the case especially in France, where all of the 40 largest companies have their own corporate ventures. Us, for example, we're managing the corporate venture fund of SNCF, and I think just for France, over the last 3 years, it has been 6 billion that has been injected in the market from those corporate ventures. In some countries, there is also a lot of public initiative. Again, in France, that won't, where BPI, the public sector bank, is very active and put a lot of money at work. There's also a new trend since, this industry has about 20 years. I started my career back in 1997. We were 5 VC in Paris. And the typical round that we did at that time was 1 million euro for a series, what we would call today a Series B, even C, and we were 5 investors to put this 1 million euro over the table. And of course we were scared because it was a lot of money compared to what we used to invest. Nowadays you can multiply the numbers by 10. Really, this market has been successful with a lot of exits. So again, the corporates came, a lot of government initiative, but also all those successful entrepreneurs that earned a lot of money with the sale of their startups and built all those startup studios or seed money incubators, like probably the German you probably know, I don't know where you're based, but you probably know Rocket Internet, for example, which is a good example of the kind of startup studios to really build businesses on a very large scale, and being able to grab some money also from institutional investor with a strong entrepreneurial footprint. So maybe a little bit about the fundraising process. So fundraising can be from 2 weeks to 9 months to 1 year. So there's no rules there. It really depends on the stage, the level, the amount of money you want to raise, the complexity of the transaction. It's more difficult if you have a transaction with both money in and money out, cash out for older investor. And again, there's no rule, but of course, if it lasts for 9 and 1 year, it means that you're in trouble because you haven't been able to convince investor as fast as you should have done. How to convince investor? Again, I don't want to scare you, but there's a huge amount of investment opportunity that come to our desk every day. And those investment opportunities look at from analysts, that's the first filter. And you have to make sure that, first of all, you go over this filter if you don't have the network to go up to the general partner or the partner you want to talk to. Obviously, this is the best way to be able to get your first meeting, but if you're not able to have this network, then you have to have the perfect marketing material. And marketing material is teasing. It's a teaser. A teaser is only 2 pages, really 2 pages. Because regarding the numbers of investment opportunity we get, we can't read the 10 pages pager. So please be nice with us. And within these 2 pages, we need to understand your product, your positioning, what kind of pain you solve for the customers, what kind of business model you're in, and what's your team. And this is the criteria that will or will not get you the first meeting with the partner. Never forget that VC and investor invest in people first. So sometimes you don't understand, you think you have the perfect business model, the perfect business plan, the perfect KPIs, and you could be disappointed because you don't get this VC that was a perfect fit for you. Maybe it's just a question of human relationship, because a VC will work together with you in good and also very bad times for 6 to 7 years. So when I was a young VC, of course, sometimes I did the mistake to finance a company where rationally speaking, the product was perfect, etc. I understand. As a CEO, I'm not sure I really get along with him very long time, but let's forget about it. I do it because the product is perfect, the market fit is perfect, and it didn't work out actually because it's a human venture, first of all, and the trust between the VC and the CEO needs to be very strong. I can't tell you what we've lived was in platform at the very beginning where I did the investment, but there was a very tough time with 4 different VCs that had 4 different views over the table, and again, the trust between the new investor and the management was very important to be able to overcome those difficulties and find a way to regain the growth that we're waiting as an investment case. There's something really that the VC really dislike is when you don't know how much of revenue you did last year. This is a very simple question, so if you don't know, that's very painful. Painful for you because it's a lack of credibility. So, no, I'm joking, but really, it's happened. It's happened really often. So, when you go for your first meeting, you won't get another meeting if the partner in front of you is not convinced that you master your KPIs. And in the SaaS business, that's very simple. What we want to know is what's your ARR, what's your growth in ARR, what's your churn. And again, if you don't know what's a gross churn and what's a net churn, and you don't understand the definition of those KPIs, this is going to be the end of your VC process. So, and again, don't try to overcome those difficulties and saying, I will show you later. You don't have another chance. So you need to be prepared at the first pitch to have the answers to all those questions. And if some of the KPIs are not that good, be also prepared to tell the VCs that you're aware of and that you have a plan to overcome, for example, a net churn that would be too high, let's say, or a growth that would be not as high as we would wait for a SaaS company of your size. Usually we ask for a project demo, and in one case out of 2, it takes 25 minutes to put the demo in place, and it doesn't work, and blah, blah, blah. And really, again, it's a pity, and you won't have another chance. So really prepare a demo. Don't go into the meeting without knowing what you're going to show. And the demo for a VC is not the demo for the client. You won't go into any detail, any functionality of the software because you don't have time. It should be a 10 minutes demo, so go to the straight points, what is very important and what is very different from what the others are doing. So that's for the marketing deck. Then there's always this question of, do we have to hire a fundraiser? Really, it depends of the size of your network within the VC community. Of course, if you are a very successful and serial entrepreneur, you don't need a fundraiser. because everyone will pick up the phone when you will call them to see what is your new venture. If you're not known and you don't have this network, you absolutely need a fundraiser, just to teach you how to build your pitch and just to give you this credibility that you need to have this first meeting. Because again, within the huge amount of deal flow that we get, the business plan that we're going to look at first are the ones that are referred by someone we know, an entrepreneur that we financed in the past, another VC that we've worked out in the past, or a fundraiser that we know for a while and we know is good at selecting the company. And the other reason for getting a fundraiser on board is that as soon as he knows what the VC need in terms of marketing deck, teaser, marketing, KPIs, and so on, and if your company is not ready for that, and it can happen that you don't have all the data to be able to really understand your net growth churn, for example, or really understand how your cohorts are working, it will have a working session or a lot of working session with you before going outside to make sure that you're going to be prepared and you're not going to miss the different meetings. And it's also important to manage a timeline and a process, because if you don't have the connection, you will probably try to reach 50 different VCs. So 50 relationships that you have to open. This is a sales process again. And if you don't have time because you're selling to your customers, you're taking care of hiring your people, you're doing a lot of things within your day, if you don't have time to really do the commercial job and to get back to them and fuel them with the information and so on, you won't get it. It won't happen. So this is something that the fundraiser can do for you. Of course, it costs some money, and from 2 to 5, even sometimes 7% of the fundraising. But raising fund is very important for your business. If you don't do it, you just fail, and at the end of the story. So I think you should do it professionally as you can. Then I won't have time to cover how to pick up the right VC. So most of the time, at the very beginning of the story, you have no choice. So you take the money you get, and that's it, and that's fine. I mean, you're doing what you can. If you have the chance to be able to choose between one of two, yes, first of all, take a specialist of your business. Because if you have someone who is a generalist in front of you, who is investing in B2C marketplace, and the day after in biotech, the day after in whatever, as soon as you will have trouble into your business, and you know it always happens, this guy or this woman will come to panic very quickly, and this can be very dangerous for you. If you need a bridge investment, for example, and you have an investor that don't trust you anymore because he doesn't understand how this market works, and for example, because of a lack of understanding of the market, think that Google is your main competitor and there's no way that you can make it, then it's the end of the story again. Because you won't be able to raise another round of capital if your former investor does not participate to the round, obviously, because any new investor will ask, oh, and the old guys, how much of the money do they put on the table? So the first investor is very important to pick up. So you need someone that understands your business. You need someone that you trust and you can go along with. And think as a fundraising with a VC as a marriage. This is what it is. You're getting married with somebody. This is just that the divorce is announced in 6 years. but this is a marriage. And again, you need really to take care of who you're going along with. Do not hesitate to pick up your phone and call the entrepreneurs of the portfolio to really understand how the VC behave in bad times. We're talking about how the VC behave in bad times. Do you have in front of you someone that will jump to another deal because they think that this one is lost? Or do you have someone who will help you and be alongside with you and taking care of the difficulties and help you in those tough times? And of course, usually when entrepreneurs try to raise funds, the first thing that comes to their mind is, I want to get the higher valuation. I'm afraid this is not the right way to pick up a VC, because dumb VC pay very high price. That's a rule. Smart VC usually pay the right price, the market price. And now in the SaaS business, we have a huge amount of data. You know, KeyBank, for example, is doing a very nice study every year with exactly what the value of a SaaS startup regarding the hair, the growth and whatever, and the type of business they're in. So the fair market price is quite well known, and it shouldn't be a very tough discussion. Usually, and I go to the other slide, and usually also the PAs of the entrepreneurs, I want to get a higher valuation. To get a high valuation is very simple. I'm going to do a very aggressive business plan with very high growth and very high numbers. Yes, you can do that. Maybe you got someone that will believe into your business plan, but don't forget that afterwards you'll have to deliver the business plan. And again, a lot of entrepreneurs get hung up in this tricky play. This is really tricky. Because you can be behind your business plan by 10, even 20%. It doesn't matter, it's a game. You can't be behind your business plan by 50 or 60%. Because then what's going to happen? It's very easily. The VC will get nervous and very nervous. It will stop your burn rate. It will usually fire you and get another CEO on board. This is always the kind of story that happens. So it's really a balance that you should have between ambitious. Of course, if you're showing a business plan growing 10% a year, you won't interest anyone. But if you're too aggressive and you don't deliver, you may end up in really in trouble. Most of the time that's the case. What can I tell you then? I have a clear vision. I covered with the question of the woman. This is very important to get differentiated from all other startups and scale-ups and entrepreneurs on the market. And usually you think you're the only one doing that, and that's not the case. So before you go to a VC, make all the research, go to conference, try to find any tiny startup that is doing something that could be similar to your business. Because if you're entering in a meeting with a clear map of who is your competition and what your advantage is, then you can have competition, of course. If there's competition, there's a market. If there's no competition, there's no market, probably. But you need to be aware to figure out what makes you different from the competition. If you go into a meeting with a VC and your main competitor is lacking on the slide, you won't have another chance. What can I tell you more? Metrics, I've covered that. Find a VC who share the same value as you. Value, for example, do you want to do a quick win? Like, for example, there's entrepreneurs who are very good at making businesses in 5 years, sell those businesses because they've built them just to sell them to Salesforce, for example, because they know that they're lacking this product, and they're very good at that. And there's some VC to find in this kind of plan. There's other entrepreneur that think very long term, saying, I need 10 years to enter into that market because I want to reach a large enterprise client. It's going to take time. And there's VC to find on those. And don't mix it up because it won't work. I think this is the message that I wanted to share with you. And on the term, on the structure of the deal, you can have a very high valuation, but pay attention to the terms. There's very tricky terms in the VC industry, legal terms in a term sheet, like, for example, liquidation preference. A simple liquidation preference is okay. You know what it is? It's the VC is asking for the coverage of its money before you earn some money into a deal, to protect himself, for example, for a business plan that is not delivered and we have to sell the company on fire, let's say. It becomes very tricky when those liquidation preference gets some multiple or some interest in it. Because if a VC is asking for a 2x liquidation preference, for example, is putting 10 million euros in your company, a 2x going to be a 20 million euro that you're going to serve to this VC before you get anything for you and for any ordinary shareholders. And it can be even more tricky because 2x you can understand. Sometimes it's expressed like 10% capitalized interest and make the math what it is after 5 years, 6 years or so. So it can be very tricky. So that's one thing you should pay attention to. The other things to pay attention to is a ratchet. Usually I don't put any ratchet on Series A because I pay the fair price and I don't want to put the company into trouble for the Series B fundraising. But most of my VC colleagues put some ratchet even at very early stage. There's different type of ratchets. I have no time to cover all those types, but usually it's fair when the ratchet is an average of the amount. You know what a ratchet is? A ratchet is, for example, if you're raising a Series A at a 10 million valuation, and the Series B is raised at a valuation under 10 million. Let's say you've failed and it's 8, for example. Then the VC, the first VC, gonna ask to be able to get the price of the new VC, which is sometimes unfair because this is you that gonna pay for all the failure, and the VC will not suffer from the failure. And again, this is his or her decision, so it's not really fair. So usually what you should ask is a weighted average ratchet, which is, okay, you've paid a too high price, I recognize that, but we're going to do the average between the price of the new VC and the price you paid. So you will be covered for the failure for half of it, but not 100% of it. This is something to pay attention to. Pay attention to also to the board structure. There are some VC that are very hands-on and will almost kick you out of your board or kick the founders out of your board at the very beginning at Series A. That's obviously not good for you and that's not good for the company. And that's a good transition to how to do a board structure. Usually a board with more than 5 members doesn't work, just for a very practical reason. You can't find dates in the calendar to get 10 people around the table together. And the more you had people, the more you will have different view, and you as a CEO or as a management team will be completely lost. So 5 members is good, and pay attention that people get along one with another. If within a Series A, usually you have 2 investors. Make sure that the 2 investors have worked together before and have a good history together. If that's not the case, that's a risk for you. And make sure you have independent board member around the table. The independent board member, of course, can bring a lot of value if they're coming from your industry. They have a network, they have an understanding of your business, they can help in many manners. But they can help also when you're getting into a tough time because they're going to be neutral. Usually what happens in tough time is that you have the entrepreneurs and you have the VC board and they fight with each other and trying to figure out where does the failure come from. And that's not the right way of trying to solve problems, obviously. But that's the way, but again, it's a human venture, so that's the way people react usually. If you have an independent board member who usually is a former entrepreneur, he will be able to do a kind of magician work between the VCs and the entrepreneur to make things less emotional and rational and take the right decision. So this is very important to really make sure, even at the very early stage, Series A, even seed, that you have independent board members that trust you for a while, know you for a while. It can be former mentors, it can be someone, your former boss in your former company, whatever, someone you trust, know you for a while, and will be a very nice help if things get tough. How can you leverage your board? Usually the mistake that most of the entrepreneurs are doing is not to tell the VCs and their board when they are in trouble, trying to figure out that they can solve the problem by themselves and that they will tell the board, I have this problem, but I have the solution and no way we discuss about it, it's covered. Usually it's not like that thing happens. You have a very important issue. you're trying to solve it, it doesn't work, and when there's no other way than telling to your board that you are really in trouble. There's a long time that goes through, and your board gets very nervous. So that's not the way to work with a board. The good way to work with a board and with investor is to trust their knowledge. They know your industry. They've been on board of companies for many years. So they don't believe in fairy tales. They know what the business is. They know how hard it is. They know that they will get bumped on the road. So be transparent. Tell them as soon as the problem gets to you. If it's, for example, a funder that want to leave, a very important person. If it's a customer that you're gonna lose and will break your ARR, for example, especially if you are in a fundraising process. Things that are very important like that, you should share with your board, especially because. Maybe for you it's very emotional, it's very tough because it's the first time you've seen that in your career. For us it may be the 5th or 6th, and we may just tell you, well, it happens always, so don't worry, and we're going to do that, and that, and we're gonna overcome that issue. The more you share with the board, the more you get some networks. So for anything, any new business, any new customer that you want to reach, just ask to your board, do you know those people? How can you help me? What do you think about my new marketing positioning? What kind of bell does it ring? So really, if you're not transparent, you won't get any value from your board. And then I've tried to put that in a little bit of humor just to summarize what I've said. So what's the process of a fundraising? So usually it's starting like Mowgli and the cat snake. It's a mutual seduction exercise. So you're going to tell the VCs how nice your company is, what kind of growth it can reach, and that the best company in the world you could finance. And the VC is going to tell you how much he can help, how much you know your business, what a network he has. So it's really often start like this.
Wait. So let me get that straight. They're both the snake?
I'll let you have your view on that. They can be both the snake. No, I would say Mowgli could be the entrepreneurs and the cat, the VCs, but you see here, I'll let you have your own view on that. So I guess all of you have recognized the Beagle process, right? Because as soon as you get the money, it's really, it's a fest, it's a party, and you want to spend it as soon as possible. And what happens? Usually a few months after the honeymoons, you don't deliver the business plan, of course, because it was so high, with so much expectation and you're just a human being, that you're not being able to deliver. And usually, it's like the Tom and Jerry stories, and here it's pretty clear who is Tom and who is Jerry. So the VC get nervous, and of course, it's the fault of the entrepreneurs. It's a business that's not delivered, and he is very nervous because he put a lot of money at work, and he has investor on his own, and a lot of pressure to get the money back. So you need also to understand the kind of situation where you put your VC when you don't deliver the business plan. And usually, because we're all human beings, it's getting tough between people, and trust is going away, and that's a very bad thing, and that this could kill a startup. And usually the entrepreneurs is like this little chicken saying, oh, it's too unfair, well, this VC is a too nasty person, I'm in a situation where I'm working hard every day, I'm getting up at 6 in the morning, I have only 5 hours of sleep, and there's this stupid guy who is on his desk shouting at me and so on, does not understand my business, does not understand how it's hard, and so on. So,
just to be clear, that wasn't platform SEO.
Obviously not. Obviously not. And saying it's too unfair. So no, that's just some humor, but really it's usually getting like that. So my message is, don't pick up the wrong cartoon. What you should play is Cinderella. And why should you play Cinderella? Because rules are very clear with Cinderella, you know. Her aunt just say, hey, I give you all what you need, a very nice dress, a very nice car, everything that you need to seduce the prince. But you should be back at midnight. If you're not back at midnight, you lost everything. And the prince, of course, will see you in very bad shape and you won't be able to get the prince. So that's my point. You should respect the contract you have with the VC. So what would be the 5 commandments to an efficient entrepreneur? First of all, build ambitious but realistic business plan. Business plan that you can reasonably achieve. If not, you're going to be hanged. That's it. Be ready for difficulty on the roads. I know, I'm an entrepreneur myself. I've built enough after 15 years in venture capital. I was very optimistic. I thought I would be able to raise a 100 million fund at the very first time. This has not been the case. It took me 2 years and a half to raise the first 40 billion. And of course, we are entrepreneurs, we are optimistic, but we need also to be realistic and probably to have someone next to us, close to us, to be a more realistic person and to be able to temperate a little bit our thinking. One thing which is very important is remember that the money from your investor doesn't come from nowhere. Usually it comes from people that have worked hard, especially us at High Enough. Most of our LPs are entrepreneurs, family offices, so people that have worked 30 years to get their money and that are kind enough to reinvest in younger entrepreneurs to give them the chance to build their own business. There's nothing that really gets me more nervous than someone that said, you don't understand my business, I cannot decrease my burn rate because my burn rate is that, and I can't do its work. When you do not deliver the revenue line, you have to adjust your burn rate. If not, you won't get any other funding. That's so simple. There is a very clear milestone of what you should get in terms of number to get a Series A, Series B, Series C. If you're not there, you're not there, and that's it. So, of course, you can take more time than what you've thought to get your numbers, but you can not burn twice as much as the money the VC get to you to go to those milestones. Trust his or her experience. Usually when things get bad, and of course it's not a platform story, because a platform story is a very nice one where everything gets well. Usually you have a CEO in front of you saying, but you don't understand my business. Come on, guy. I'm in the business for more than 20 years. You were at college when I was starting financing entrepreneurs, so please, I do understand your business much more than you understand what's happening right now. That's very important to trust your investors and the experience. Even if they haven't been entrepreneurs by themselves, some of them have been entrepreneurs by themselves, but even if not, they've seen so many cases in their portfolio that the things that are happening to you right now have happened to other companies of their portfolio, and they have been able to overcome that. But this is for the entrepreneurs, but I have also some commandments for the very efficient venture capitalists, because there's some bias also in our profession. First of all, venture capitalists should not behave just like Jerry with Tom. You know, this is not the way you solve issue when bombs are pumping into the road. So really, everything is in being in openness, in kindness, and take the time to really be receptive and get the trust of the entrepreneurs. If you have never time to just simply discuss, if you are always late in the board meetings and go before it ends up, there's no way that the entrepreneur can trust you and share the difficulties. Sounds very simple, but a lot of my colleagues do not read the board packages. which is very frustrating for entrepreneurs because you're putting a lot of efforts into producing these board packages. And when someone jumps into a board and asking questions that have been answered into the board package, I can understand how frustrating that can be for you. So we have to read board package, obviously, and ask questions that make sense, getting better and advance as a board. Of course, respect the entrepreneurs. That's especially true for young VC that have never been entrepreneurs by themselves and who have never been implicated in fundraising, for example. Because the tough part of our job is fundraising. So as soon as we've done fundraising, we know what you experience every day and in every fundraising. And usually when things turns to be tough, there's a lack of respect somewhere, and even young VCs as a solution have always, the first that pick up into their mind is, I have a bad CEO, I have a bad team, I will change everything. And usually when they do that, they just kill the company because this was not the right answer to the issue. And again, and the other BAs can be also that you've been an entrepreneur yourself and you're too kind and too empathic towards the entrepreneurs. And you're not, and that's not your role. Your role is really to be this kind of business partners that can tell things, even tough things, when something failed. Being always kind, being always respectful. But if you don't tell the things because you're not brave enough, for example, things won't work out. That's simply that. And another thing that can kill a company is when you don't have any consensus within a board. Imagine 5 different investors, 5 different views, and this happens very often. The CEO doesn't know what to do. There's one of the board members that say that they have to do a freemium business model. The other one say, obviously not. We have to go for enterprise clients and asking for a lot of money. And when you have such different views into a board, that's just impossible to build a strategy that everyone is going to trust. So first of all, when you pick up the investor, make sure that they work together before, or that they share at least the same value, and make sure that you have a nice communication between the board member and between the board. In almost every country, you have at least, in France, I think this is something like 4 teams that are focusing on impact. I know in Germany there are a few of them. I don't know the UK market so well, but I'm pretty sure there's some of them. And usually they have tech specialists within the fund, and they have not only financial KPIs, just as we have as VC, to figure out if an investment is a good one or not. They have also what they call their impact KPI, which could be your software, for example, is used to reduce plastic in the sea. I want to see specific KPIs on how much, how do you reduce the issue? And even I've seen that they put stock option plans on impact KPIs rather than on financial KPIs. So you should really spot those funds that have this impact view. And
would that be a different way of application? Would that have to be more kind of detailed?
I think you should do just like a classical VC with your market positioning, being very clear of what you bring to the market, introduce your team and so on, but also with the KPIs that you will focus on regarding the impact you're going to have on the environment or whatever you're sorting as an issue. And usually if the impact funds don't have a deep knowledge of the SaaS business, they will grab another investor that will be an IT investor just like us. For example, we have a company into our portfolio where we had an impact fund coming in Series B, and they don't, or there's no that knowledgeable in SaaS actually, they don't really know this business model, but they know very well our customers, they know the World Food Program, the ONU and so on. And that's a mix that makes a good work around the table. Yes?
What are the most used KPIs which you are using when you evaluate the valuation of the company from your side?
When I'm evaluating a SaaS business, you mean?
Yeah.
Yes. First of all, the growth of the company in terms of IRR booked. I'm looking also at the business model. Are you able to get multi-year contract or just 1 year contract or no contract at all? It depends, of course, if you are selling to enterprise softwares or SMB software. But even in SMBs, you should be able to get the 3 years Salesforce-like contract, and it should be good reason why you don't get it. So the duration of the contract, the growth of the ARR and the committed ARR, of course the cost of customer acquisition, and here there's metrics. I have no time, I think, to enter into all those metrics, but cost of customer acquisition obviously is linked to growth. If you're spending 40% in sales of marketing of your P&L, it's okay if you get 100% growth, 80 to 100% growth. It's bad if you're getting only 10% growth. Just, I'm trying to schematize a little bit, but you can see over the internet, there's some VC who have brought together all those criteria. Especially Battery Ventures has a good website on that. You will find all of those. So cost of customer acquisition, LTV, and cost of customer acquisition to recover LTV. If I have 6 months cost of customer acquisition and an LTV of 24 months, that's a very nice business model. If I have a contract duration of 12 months, an LTV of 12 months, and a cost of customer acquisition to be recovered 18 months, I'm in a bad shape, because as soon as I get new customers, I burn my cash. Those are the things we're looking for. Of course, we're very cautious about churn. A nice business model is a business, and of course it's different if you're in the enterprise business and if you have a stickiness of your solution. A platform, for example, has a very high stickiness to the customers because it's used to produce a website. So as soon as you're happy with the solution, you won't change the solution. So the stickiness is very high and the churn is very low. That's because it's a PaaS and it's really used in production. I have other companies into my portfolio that are selling learning engagement platform, for example. This is not that sticky. You can change of learning engagement platform. So they have to be very cautious about their churn numbers. So usually a company that is able to have a net churn at 0 when there's not a lot of stickiness into the product is a company that is doing well. Meaning that how do you calculate the net churn? Your gross churn is the numbers of customers or the numbers of euro or dollars that you're losing per month on your customer base, okay? The net churn is the difference between the upsells you're doing on the customer base and the dollars or the euros that you're gonna lose on your customer base. If this is 0, you have a nice business model. If you are in a, let's say, classical, not a sticky SaaS business model. Is it clear to you? Yeah. And usually this is how we try to drive the team, being able to be at a net churn of 0. Of course, there's businesses where stickiness is very high. I don't know what the net churn on a platform, but it's really, really high. I don't remember the numbers, but it really depends on the stickiness of the business. And also of the size of your customers. Usually, as soon as a customer is very big, the churn decreases, but the CAC is higher because the sales cycles are longer. As soon as you are in SMB market, you have shorter sales cycles, usually shorter average order value, but your churn is an issue usually. Yeah, that's really roughly speaking.
Valérie, our churn is less than 5%. Was that the question you were asking?
I have in mind that your net churn is positive, and it could be 5%. Yeah. So let's take this example: a net churn that is 5%, meaning that you're selling more in upsells to your customer base, then you're losing customers. For example, you can lose, I don't know if the numbers are right, 10% of your customer base in dollars. If you're doing 5% of net churn, it means that you've been able to upsell 15% to your customer base.
You're correct. The net churn was, at least in one of the previous quarters, it was negative churn.
Yeah, that's what I had in mind. Yeah.
And one more question, just out of interest. What sort of business would benefit from crowdfunding as opposed to more traditional venture capital?
Yeah, this is really reserved for B2C businesses. If you're selling video games or new virtual reality video games, or I don't know, there's a new GoPro camera, whatever, it can be useful because you want to grab your first customer with a crowdfunding, actually. I don't know if it's still working, to be very honest, because there have been lots of deception around crowdfunding from the crowd. A lot of investors never get their product, for example. So it's not a fashion anymore, from what I see, at least in our market in France and Germany. For B2B investment, I'm not even sure you'll be able to raise money from the crowd and from those platforms. Yes.
If I have a good business and it's growing all the time, cash flow is positive and everything goes well, but I want to grow faster, why should I prefer VC money to, for example, bank loan?
You should prefer a bank loan if you're profitable. I was talking of businesses burning cash. Of course you should prefer bank loan. There's no dilution and money is almost free right now. If you're profitable, there's no questions. I guess most of the company here in the rooms are still burning money, right? Is there any other question?
Is there how do venture capitalists view software that comes with, not software as a service, but software that comes with services attached? So like my business.
Usually badly. Yes, really it depends of the proportion and it depends of the kind of software you're putting in place. Obviously, I have two paths in the portfolio, which are platform and intercloud. Intercloud is a telecom path to really personalize the routes of the data for very large enterprise and make them secure. Of course, they have to be built into the SI system. So there's a lot of services just to put the system in place. It's not just a SaaS that you can connect to an API. So they can justify that they have 30% of their revenue in SaaS. And all those kind of businesses will have, and it won't be scaring a VC because it knows that then there's a lot of stickiness of the software solution within the customers. This would be very different, for example, if you're having 50% of services, managed services around your software because your customers are not able to handle your software. And it happens very often in ad tech SaaS solution. Those solutions are so complex that the SaaS vendors are forced to provide managed services to use the software for their customers.
Which branch?
Ad tech businesses like DSP, some of them are so complex in the mobile and so on that usually they have a huge amount of managed services. And when you're asking the question, they said, it's complex stuff, so we're doing the job for our customers. Then you're not a SaaS software company anymore. You're an agency using a tool, but you're not a SaaS company. Usually VC likes a very pure business model. 100% SaaS is perfect. Obviously, it never exists. It can exist in I have a company into my portfolio, Hago Rappels, who has no services because they serve small and medium businesses on very low average amount worldwide and so on. But usually when you are going to mid-market or enterprise market, you have some services. As soon as it's less than 20%, it's okay. You can explain why. And you can explain also to the VC that you need to understand how your software is getting into the environment of the customers by yourself, because usually the VC is going to ask, wow, that's stupid revenue. Well, don't you do it with partners? Let them to Capgemini or all those guys and concentrate on your software. And that's probably not the right things to do, because you need to have the feedback from your customers and from the market of what doesn't work, what are the bugs, connecting to an Salesforce.com APIs or SAP APIs is not that easy. Sometimes it just doesn't work or doesn't work properly. So you need to have this knowledge. So you can probably explain it if it's less than 20% of your revenue. Above, it's becoming difficult to raise money because you're going to be seen as a kind of agency rather than a SaaS provider.